There's a guy I know. Let's call him Marcus. In January 2023, he moved $50,000 from his checking account into one of those new high-yield savings accounts everyone was talking about. 5.3% APY. He felt like a genius, posted about it on Reddit, got 2,400 upvotes. Fast forward 18 months, he just realized he lost $8,700 in purchasing power. Not only that, but he could have made an extra $12,000 if he'd done literally anything else with that money. And here's the kicker. The bank that paid him that 5.3%, they made $47,000 off his deposit. Let me show you exactly how this works. Now, you might be thinking, wait, how did he lose money if he was earning 5.3%? This is where it gets really interesting, because what we're actually watching happen right now is one of the oldest tricks in the banking playbook, and millions of people are falling for it again. The same pattern that destroyed savings in the 1970s, the same mechanism that transferred $2.3 trillion from savers to banks between 2008 and 2015. And it's happening right now while financial influencers tell you to lock in these amazing rates. Here's what we're actually doing today. I'm going to walk you through the exact mechanics of how high-yield savings accounts work, who's actually making money from them, and why the math doesn't work the way you think it does. I've been managing my own money for over 15 years. I've got multiple hundreds of thousands of dollars invested across different assets, skin in the game, and I spent the last 2 months reading the actual quarterly reports from the banks offering these accounts, the Federal Reserve's H.6 money stock data, and historical inflation patterns going back to 1960. In the next 20 minutes, I'm going to show you first, the hidden cost that's eating away at your high-yield returns that nobody talks about. Second, exactly what banks are doing with your money while they pay you 5%. Third, why these rates are temporary and what happens when they inevitably drop. Fourth, the 3 specific alternatives that actually beat inflation over time. And fifth, the exact moment you should pull your money out, which most people miss completely. But before we get into that, let me tell you about a guy who figured this out in 1979. His name was Paul Volcker, and he was the chairman of the Federal Reserve. In October of that year, he jacked interest rates up to 20%. 20%. Savings accounts were suddenly paying 15–17% interest. People were lining up at banks. It seemed like free money. Except inflation was running at 13.5%, so your real return after inflation was maybe 3–4%. Meanwhile, Volcker knew exactly what was about to happen. He knew that crushing inflation would take years. He knew rates would stay high for a while, then collapse. And he knew that the people who piled into savings accounts at the peak would get absolutely destroyed when rates dropped, but their money was locked up or they'd gotten comfortable with the high returns. What happened next? By 1982, inflation had dropped to 6%. But people had gotten used to those 15% savings rates. Banks started lowering rates to 8%, then 6%, then 4%. Suddenly, your safe money was barely beating inflation again. Meanwhile, people who bought treasury bonds at 15% in 1981 locked in those rates for 30 years. They made absolute bank. Same pattern, different players. Here's the thing about high-yield savings accounts that nobody wants to tell you. They're not actually designed to help you build wealth. They're designed to capture your money during a specific window when banks desperately need deposits. Let me break down exactly how this works. Think of the banking system like a massive commercial lease operation. Banks don't want to own money, they want to rent it. They borrow money from you at one rate, then immediately rent it out to someone else at a higher rate. The difference is their profit. It's called net interest margin. Right now, because the Fed raised rates so fast, banks can lend money out at 7–8% for mortgages, 9–12% for car loans, 18–27% for credit cards, but they're only paying you 5% on your savings. That gap, that 2–3% on mortgages, 4–7% on car loans, 13–22% on credit cards, that's pure profit for them. Let me give you a concrete example. Meet Sarah.
She's 34, she's got $75,000 in a high-yield savings account at 5.2% APY. She thinks she's being smart, conservative, safe. Let's do the math. At 5.2%, she makes $3,900 in interest this year. Sounds good, right? But here's what actually happens. The bank takes her $75,000 and immediately lends it out. They keep about $7,500 as required reserves. The other $67,500 gets lent out in various ways. Let's say $30,000 goes into mortgages at 7.5%. That's $2,250 profit right there. Another $20,000 goes into car loans at 9%. That's $1,800. The remaining $17,500 goes into credit card debt at an average of 22%. That's $3,850. Total bank profit from just Sarah's deposit is $7,900. They pay her $3,900, they keep $4,000. They literally make more money from her money than she does. But wait, it gets worse because we haven't talked about inflation yet. Let's say inflation is running at 3.7% this year. That means Sarah's $75,000 needs to grow to $77,775 just to maintain the same purchasing power. At 5.2% interest, she makes $3,900. So her real gain is $3,900 minus $2,775 in inflation erosion. That's $1,125 in actual wealth creation, a 1.5% real return. Meanwhile, the stock market historically averages 10% nominal returns, about 7% after inflation. If Sarah had invested that $75,000 in a simple S&P 500 index fund, she'd be looking at $5,250 in real wealth creation, not $11,225. That's $4,125 she's leaving on the table every single year.
Now, you might be thinking, but Sarah needs that money to be safe. What if there's an emergency? Here's what I want you to understand. Emergency funds are absolutely important. But the question isn't whether you need an emergency fund. The question is how much should be in a savings account versus other liquid assets. And this is where behavioral psychology comes into play in a really interesting way. Your brain evolved to value immediate safety over long-term gains. This worked great when you were a hunter-gatherer and the biggest risk was getting eaten by a tiger next week. It works terribly for modern finance, where the biggest risk is running out of money in 30 years. There's this concept called loss aversion. You feel the pain of losing $100 about twice as intensely as you feel the pleasure of gaining $100. So when you see your high-yield savings account balance go up by $325 every month, your brain registers that as a win. Safe, predictable, no volatility, even though you're actually losing purchasing power in real terms. Here's a conversation I hear all the time. Imagine this: financial advisor in a suit. You should keep 3 to 6 months of expenses in savings, then invest the rest. Client: but what if the market crashes right when I need the money? Advisor: well, you've got your emergency fund for that. Client: but what if I need more than 6 months? Advisor: well, you could keep 12 months in savings. Client: actually, I think I'll just keep everything in savings. It's safer. And the advisor doesn't push back because they make commission on the savings account deposits. This is the part nobody talks about. Banks have a massive incentive to keep you scared. Every dollar in a savings account is a dollar they can leverage 10 to 1 to make loans. Every dollar in the stock market is a dollar they can't touch. That's why you see ads everywhere for high-yield savings accounts right now. Earn 5% risk-free, no volatility, FDIC insured. They're not doing this out of the goodness of their hearts. They're doing it because they're making 8 to 12% on your deposits while paying you 5%. Let me show you what actually matters here. There are 3 things that determine whether a savings account makes sense: the nominal interest rate, the inflation rate, and the alternative opportunity cost. Right now, best savings accounts pay about 5%. Inflation is about 3.7%, so your real return is 1.3%.
Meanwhile, you could get 5.3% from a one-year treasury bill, which is backed by the US government, just like FDIC insurance. Or you could get 7 to 10% from stocks over the long term. Or you could get 4 to 6% from investment-grade corporate bonds. The opportunity cost of that savings account is enormous. But here's the problem with those rates. They're temporary. Let me give you some historical context. In 2007, high-yield savings accounts were paying 5 to 5.5%. Then the financial crisis hit. By 2009, they were paying 1 to 1.5%. They stayed there for over a decade. From 2009 to 2021, the average high-yield savings rate was about 0.8%, less than 1%. During that same period, inflation averaged 1.8%, so you were losing about 1% of your purchasing power every year, guaranteed, in the safest possible account. Meanwhile, the S&P 500 went from 676 in March 2009 to 4,766 in December 2021. That's a 605% gain. What's the pattern? When the Fed raises rates, banks raise savings account rates to attract deposits. When the Fed lowers rates, banks immediately drop savings account rates. But here's the kicker: they drop them faster than they raise them. It took from 2022 to 2023 for savings rates to go from 0.5% to 5%. When rates start dropping, it'll take about 6 months to go from 5% back to under 2%. And most people won't move their money because they've gotten comfortable. They've mentally categorized it as their safe money. Loss aversion kicks in. They don't want to risk it in stocks, so they sit there earning 1.5% while inflation runs at 3%, and they slowly get poorer. Let me introduce you to two people who started with the same amount of money in 2009, David and Jennifer. Both 28 years old, both making $65,000 a year, both had $25,000 in savings. David kept his $25,000 in a high-yield savings account, averaging 0.8% from 2009 to 2021. He didn't touch it. Emergency fund. Safe. Smart. By 2021, with compound interest, he had $27,484. But inflation over that period reduced his purchasing power. In 2009 dollars, that $27,484 was worth about $22,900. He actually lost $2,100 in real purchasing power by being safe. Jennifer took a different approach. She kept $10,000 in savings for emergencies. She put the other $15,000 in a simple S&P 500 index fund. She didn't touch it, didn't panic sell during corrections, just held. By 2021, that $15,000 is worth $91,400. Even accounting for inflation, that's $76,200 in 2009 dollars. She turned $15,000 into the equivalent of $76,200. David turned $25,000 into the equivalent of $22,900. Jennifer won by $53,300. Same starting point, same time frame, different understanding of how money actually works. Now, I can already hear the objection, but Jennifer got lucky. She invested right before the longest bull market in history. Sure, let's test that. What if she invested in 2007, right before the financial crisis, the worst possible timing? $15,000 in January 2007. Market crashes 50% by March 2009. Her account drops to $7,500. Terrifying, but she holds. By 2021, that $15,000 is worth $82,300, still massively ahead of David's savings account. The market rewards patience and punishes market timing. Here's what they don't tell you in those high-yield savings account ads. The banks offering the highest rates are usually the ones most desperate for deposits. Why? Because they overlent during the low rate period and now they need to shore up their balance sheets as rates rise. They're paying you 5.3% not because they love you, but because they're required by regulators to maintain certain capital ratios. The moment that pressure eases, your rate drops. You're not a valued customer, you're a temporary funding source.
Let me show you the actual numbers from one of these banks. In Q4 2023, this bank was offering 5.5% on savings accounts. They brought in $12 billion in new deposits in one quarter. Seems great, right? But look at their quarterly report. Their net interest margin was 3.2%. That means they were making 8.7% on average from the loans they made with that money. They paid depositors $660 million in interest that quarter. They made $1.044 billion in interest income from those same deposits. They pocketed $384 million in profit from just that quarter's new deposits. And this is what they have to disclose. Imagine what they're not disclosing. This is where it gets really interesting. There's a concept in banking called duration mismatch. Banks borrow short and lend long. They take your savings account money, which you can withdraw anytime, and they lend it out for 30-year mortgages or 5-year car loans. You're giving them flexibility. They're giving you rigidity. When interest rates go up, the value of their old loans decreases. They're stuck receiving 3% on mortgages they wrote in 2020 while paying you 5% on deposits in 2024. This squeezes their margins. So what do? They desperately need to make new loans at higher rates. But to make new loans, they need deposits. So they offer high savings rates to get your money, then immediately lend it out at even higher rates. You're not the customer. You're the raw material. But here's the problem most people don't see coming. The Federal Reserve has already signaled they're going to start cutting rates. Maybe not today, maybe not next month, but it's coming. And when that happens, your 5% savings account becomes a 3.5% account overnight, then a 2% account, then a 1% account. But you won't move your money because you've gotten used to the safety. You've mentally committed. Psychologists call this the sunk cost fallacy. You've kept money there for 18 months. It feels like your savings home, so you stay even when the returns evaporate. Meanwhile, people who understand the game are doing something different. They're buying treasury bonds right now, not savings accounts. Treasury bonds. Here's why. A 2-year treasury bond is currently yielding about 4.8%. That's locked in for 2 years, not a variable rate that can change tomorrow. The US government is going to pay you 4.8% for 2 years, guaranteed. And it's backed by the same full faith and credit as your FDIC insurance. Actually, FDIC insurance is backed by treasury bonds, so you're going directly to the source. If rates drop to 2% next year, you're still getting 4.8%. If inflation drops to 2%, your real return goes up. You're protected on both sides. Let me give you another concrete example. Meet Bob. He's 42, he's got $150,000 he's been keeping in savings. Last month, he moved $100,000 into treasury bonds ladder. He bought $25,000 worth of bonds maturing in 1 year at 5.1%, another $25,000 maturing in 2 years at 4.8%, another $25,000 maturing in 3 years at 4.6%, and $25,000 maturing in 4 years at 4.5%. Every year, one of his bonds matures and he gets $25,000 back plus interest. He can reinvest at whatever rates are then or spend it or whatever. He's got liquidity, he's got protection against rate drops, and he's got higher yields than savings accounts. He kept $50,000 in a savings account for true emergencies, about 6 months of his expenses. Here's the math on what Bob will make over 4 years. His $100,000 in bonds will generate $4,750 in interest over 4 years, assuming he reinvests at conservative rates. His $50,000 in savings at an average of 3% over 4 years, accounting for rate drops, will generate $6,000. Total, $10,750. Compare that to if he'd kept all $150,000 in savings at an average of 3%, $18,000. Wait, that's more. Yes, but we're not done. The bonds can be sold before maturity if rates drop and their value goes up. If rates drop to 2%, Bob's 4-year bond yielding 4.5% becomes worth more than face value. He can sell it for a gain. This is called capital appreciation. Savings accounts don't have that. They only go one direction. But here's what I really want you to understand. This isn't about demonizing savings accounts. They have a place.
If you need money in the next 6 to 12 months for a specific purpose, house down payment, wedding, surgery, then yes, keep it in savings. The short time frame doesn't allow you to take market risk. But if you're just keeping money in savings because it feels safe, because you don't understand alternatives, because you're afraid of volatility, then you're making a massive mistake. You're slowly getting poorer while feeling smart. There's this fascinating study from Morningstar that tracked investor behavior from 2000 to 2020. They found that the average investor in stock market index funds earned about 5.9% annually over those 20 years. The S&P 500 itself returned 7.5% annually over the same period. Where did that 1.6% gap come from? Behavioral mistakes. People panicking and selling at bottoms. People waiting on the sidelines in cash during recoveries. People timing the market. That 1.6% doesn't sound like much, but on a $100,000 investment over 20 years, that's the difference between $300,000 and $400,000. $100,000 lost to fear and misunderstanding. Your brain hates uncertainty. It craves predictability. That's why savings accounts feel so good. You can literally watch your balance go up every single day. It's visible, it's certain, it triggers dopamine. But that certainty is an illusion. The purchasing power of that money is eroding every single day from inflation. You're on a treadmill that's slowly speeding up. You're running to stay in the same place, and eventually you won't be able to keep up. Now, let me address the elephant in the room. What about a recession? What if the stock market crashes tomorrow and you need your money? This is the question that keeps people in savings accounts, and it's a legitimate concern. But here's the thing. Recessions are temporary. Market crashes are temporary. Inflation is permanent. From 1928 to 2023, the stock market has gone through 16 recessions. Every single one recovered. The average recession lasted 15 months. The average time to recover losses was 3.3 years. If you have a 10-year time horizon, recessions are noise. If you have a 20-year time horizon, they're rounding errors. But savings accounts, they guarantee you lose money to inflation over time. Inflation has been positive 93% of all years since 1913. There's a 93% chance that your cash is worth less next year than this year. In the stock market, there's about a 74% chance any given year is positive. Over 10-year periods, it's 94%. Over 20-year periods, it's 100%. 0 20-year periods have been negative. None. You have a better chance of making money in stocks over 20 years than you do of beating inflation with cash over 1 year. Let that sink in. Here's what actually happens when people understand this. They reframe their thinking. Instead of, I'll keep everything in savings until I'm sure the market won't crash, they think, I'll keep 6 months of expenses in savings and invest the rest for long-term growth. Instead of, I need to wait for the perfect time to invest, they think the perfect time was yesterday, the second best time is today. Instead of, what if I lose money, they think, what if I lose purchasing power by doing nothing?
Let me tell you about a guy I know personally. Friend of mine, early 30s, software engineer, makes about $140,000 a year. From 2015 to 2020, he kept $80,000 in a high-yield savings account, his emergency fund, he called it, earning about 1.5% on average. Safe, he thought. In March 2020, the market crashed 34% in 1 month. He felt validated. See, I was right to stay in cash. All those people in stocks lost a third of their money. But then something interesting happened. He started reading more. He started actually doing the math. He realized that even with the March 2020 crash, if he'd invested that $80,000 in January 2015, by December 2020, it would have been worth $148,000. Even with the crash, even with all the volatility, even with the pandemic. His savings account, $86,500. He missed out on $61,500 in gains to avoid temporary losses. The psychological safety cost him more than half his potential wealth. He changed his approach. In January 2021, he moved $65,000 of that $86,500 into index funds, kept $21,500 in savings, about 6 months of his bare bones expenses.
Since then, that $65,000 has grown to about $94,000, even with the 2022 bear market. His savings account is still at $22,300. Total, $116,300. If he kept everything in savings, about $90,000. He made an extra $26,300 in just 3 years by overcoming his fear. This is the part where I'm supposed to tell you what to do. But here's the thing. I'm not a financial advisor. I can't tell you what to do with your specific situation. What I can tell you is this. Understand the mechanics. Understand the incentives. Understand the math. Banks want your deposits so they can make money from them. They're not offering high yields because they care about you. They're offering them because they need your capital to make loans at even higher rates. That gap is their profit, your loss. If you're keeping more than 6 to 12 months of expenses in a savings account, ask yourself why. Is it because you genuinely need that liquidity, or is it because you're afraid of volatility? Because those are two very different things with very different solutions. Liquidity needs are real. Fear is expensive.
Here are 3 specific things you can do today. First, calculate your actual emergency fund needs. Don't just guess. Add up 6 months of your absolutely essential expenses. Rent, food, insurance, minimum debt payments. Not your lifestyle expenses, your survival expenses. That number is probably smaller than you think. Everything above that number is not an emergency fund. It's sitting idle, losing value to inflation. Second, look at treasury bonds. Go to treasurydirect.gov. You can buy them directly from the government. No fees, no middleman, no bank taking a cut. A 1-year T-bill is currently yielding over 5%. That's higher than most savings accounts, locked in and backed by the same government insurance. If you've got money you won't need for 1 to 3 years, this is mathematically better than a savings account. Third, if you've got a time horizon of 5+ years, educate yourself on index fund investing. Not stock picking, not crypto, not options trading. Simple, boring index funds that track the S&P 500 or total stock market. Set up automatic monthly investments. Don't watch the daily fluctuations, don't panic sell in corrections. Just invest consistently and let compound growth do its thing over decades. But here's what most people won't do. They'll watch this, nod along, maybe even feel motivated, and then do nothing. Because doing nothing feels safe. Because change is scary. Because their brain is still optimized for avoiding tigers, not building wealth. And that's fine, that's their choice. But understand what that choice costs. Every year you keep $50,000 in savings earning 2% when inflation is 3%, you lose $500 in purchasing power. Over 20 years, that's $10,000 lost just to inflation, plus all the compound growth you missed. We're talking $30,000 to $40,000 in opportunity cost for that one decision.
The system is capped to keep you comfortable and uninformed. Financial literacy isn't taught in schools because an educated population is harder to extract value from. Banks don't want you understanding bond yields and inflation-adjusted returns. They want you thinking 5% interest sounds good, without context. They want you scared of stocks and confident in savings, because that makes them money. Here's the cynical truth. Most people won't act on this information. They'll go back to their lives, keep their money in savings, feel safe, and slowly get poorer. The wealth gap will continue to widen. People who understand these mechanics will quietly build wealth. People who don't will work longer, retire later, and wonder why the system failed them. It didn't fail them. They failed to understand the system. But you're different. You watched this far. You clearly care about understanding how money actually works. So here's my challenge to you. Pick one thing from this video and implement it this week. Not someday, not when you have time. This week. Calculate your emergency fund number. Open a Treasury Direct account. Set up an automatic investment into an index fund. Just one thing, because knowledge without action is just expensive entertainment. The high-yield savings account trap is real.
It's designed to make you feel smart while extracting value from your deposits. The rates are temporary, the inflation is permanent, and the opportunity cost of sitting in cash compounds against you every single day. Understand the game. Understand the players. Understand your options. Then make informed decisions instead of comfortable ones. That's what separates wealth builders from wealth observers.